Good afternoon, everybody, and welcome to Hands On. My name is Alana, and I'm from the Innovation Cluster. And for those of you that aren't familiar with the Innovation Cluster, we're a not-for-profit support startups working in innovation and technology. So we do so by offering advisory services, access to partners, and events and workshops such as this one. So we encourage you to apply if you have an innovative idea or a startup working in technology, and you can do that at www.innovationcluster.ca. So again, welcome to Hands-On Tax Prep for Startups with Inclusive Advisory. So today we actually have 3 CPAs from Inclusive Advisory. We have Maggie, who is the manager at Inclusive, Amy, who's a senior accountant, and the accountant, Kevin, is also online with us. They're going to be covering types of business structures, registering for income taxes, HST returns, payroll deductions, bookkeeping tips and tricks, and a lot more. So much to cover. We're going to jump right into it, and please welcome the Inclusive Advisory team.
Thank you very much, Alana. Welcome to Tax Preparation for Startups by Inclusive Accounting. So my name is Maggie, as Alana had introduced us. We've also got Amy there. Amy, if you want to give us a little wave. Introduce yourself, and Kevin right beside Amy in the same screen. So as Alana had mentioned, we've got a loaded schedule for today, and we're going to start off with the types of business structures.
So there's a couple different main business structures that we can talk about today. The first one is going to be a sole proprietorship. So typically this is the simplest business structure that's kind of out there. It's one owner. However, it does have an unlimited liability where the owner can be held personally responsible for all the obligations of the business. The next one we're going to talk about is a partnership. So a partnership has more of a structure, and it is typically a written agreement between 2 or more individuals. There is still some liability there personally, but it's split amongst the owners based on whatever the agreement is. And then the last one is a corporation. So the corporation is an entirely separate legal entity, and the shareholders do have limited liability where they're not held responsible for the business obligations. However, there are still some cases where the owner of the corporation can be held liable. So next, we're going to go on to registering for a business number. So in each different scenario, there's different business numbers that could be needed. For your sole proprietorship, you don't actually need to apply for a business number. However, you may need to apply for an HST or a payroll number. And for a partnership, you do need a business number, and you may need also a separate business number for your HST and payroll accounts. The corporation, it is definitely needed for a corporation, and it's typically issued as soon as the articles of incorporation are filed. Now, typically we have been seeing lately, they're not actually sending the letter that sends you your business number. You actually have to call CRA to get the business number as soon as it happens. And you may also need to apply for a separate HST or payroll account number. And in order to do all of this, you can just register by phone, or there's actually an online tool that you can go in and apply for these business numbers. Right. Briefly touch on is the income taxes and the way that the income taxes work under each different structure. So first, for the sole proprietorship, it's all taxed on your personal tax return. It is based on a calendar year, so your January 1st to December 31st, and your personal return is due June 15th. However, if there is a balance owing, it has to be paid by April 30th. For a partnership return, it's called a T5013, and it is a calendar year as well, so January 1st to December 31st. And that return is actually due March 31st. And then that kind of flows into your personal tax return as well. With a corporation, you have a corporate tax return, which is called a T2. You can pick your fiscal year end date of choice, which can depend on various factors. And then it's always due 6 months after the fiscal year end date. And if there's any taxes owing, they have to be paid 3 months after that fiscal year end date. So the next thing we're going to talk about is GST and HST returns. So there are two different scenarios where there is a requirement to register for HST, or you can voluntarily register for HST. You can voluntarily register if you have a lot of expenses and you're paying a lot of HST paid on your purchases. That's typically often when we see people voluntarily register, because you can recover that HST paid. However, if you have sales of more than $30,000, then you do have to register for HST. And just to note that $30,000 is kind of on a rolling year. So it could be like Q4 of 1 year plus Q1 to 3 of the current year, and it just kind of rolls forward. So it's often kind of misconceived that it's based on a calendar year and it resets every December 31st, but it is on a rolling year. And there's a couple different filing frequencies. You can do monthly, quarterly, or annually. And it is up to you as a business owner. As long as you have sales less than 1.5 million, you can be an annual filer. Once you start kind of getting into more sales than that, that's when you have to go into quarterly and monthly. But ultimately, it's going to be up to you as a business owner how often you want to file.
We do usually recommend filing quarterly. That seems to be the happy medium between the monthly filings seem to be too much work to do the record keeping, the bookkeeping, and the annual filing is usually a very large payment in one go. So that quarterly filing is that happy medium that we tend to recommend to most businesses.
Perfect. And then we're going to talk about the payroll deductions. So when you actually have employees, you must withhold CPP, EI, and income taxes on their paychecks, and you have to remit them regularly to CRA. So your remittance frequency, there are some different frequencies that you can remit these to CRA. Typically, we see monthly, but you can do bi-weekly, monthly, or quarterly. Typically, CRA can come back though and say, hey, you don't qualify for quarterly remittances, so you have to do monthly is typically what we see. So monthly is usually what people are. And in that case, if you are a monthly remitter, your source deductions are due by the 15th of the next month. So say you do a payroll from January 1st to January 31st, your source deductions are due on February 15th. So in order to do your payroll, there's a couple of different options. There are some payroll providers like ADP and Ceridian. There's also lots of bookkeepers out there that will process your payroll on a weekly basis, bi-weekly basis, monthly, however often you want to do it. Or the other option is there's a CRA payroll deductions online calculator that you as the business owner can just go in and plunk it all in, and it'll tell you what you need to pay your employee and what the deductions are that need to be remitted on that. So next we're going to talk about the owner remuneration, which depending on the structure of your business, that's going to kind of depend on what we're talking about here. So first is the sole proprietorships. So your sole proprietorships are taxed fully, your net income is taxed fully on your personal return. So you also have to, you pay your personal income taxes at the end of the year on the net income, and then you also have your CPP that you have to pay on that, your employee portion and employer portion for that. The next way is your partnerships. So it is taxed based on net income of the partnership, and then your percentage as well that goes on your personal return. And then often if there's other deductions and stuff, you can deduct other expenses on your personal return against that partnership income if you paid for expenses personally to the partnership. And then the next one is the corporation. So this is where we kind of get into the salary and dividends as the owner. So there's two different options that you can use to pay yourself. You can pay yourself on salary, or you can pay yourself on dividends. So the salary is deductible in the corporation, and then it's taxed fully personal. And then it is CPP applicable. So you do have to pay CPP on all of those earnings, including your employer portion. So you're going to pay the employee portion, but then your corporation has to pay the employer portion. And then, so your next one is your dividends, which is taxed partially in the corporation. And then it's taxed partially on the personal return. And this does not have CPP on it. So overall, we're kind of seeing that they're very similar as long as you don't take into consideration any of the CPP. So CPP, you're just kind of assuming that when you start collecting CPP, you're going to get it fully back. And it just kind of works out in a wash.
Just hang on a second. There was a question that popped up on the screen. Let's answer the questions as we go.
You want to answer as we go? Okay. Okay, Kevin, so there's a question from Charlene here. Where does LLC fall under?
LLC is a limited liability corporation. That's a US entity, not a Canadian entity. And we'll talk about LLCs a little bit when we do our US section a little bit later on.
Awesome, thank you. And what about using payroll and accounting software like Sage or QuickBooks from Patricia?
Yep, so those are other options as well that you can go in. If you have a QuickBooks subscription, you can definitely use those as well and run that yourself.
And then one more question outstanding here. Does Canada and US follow the same rules for business tax prep?
Good question. Yes, in general, you have your proprietorships and partnerships and your corporations. The US has a few other entities like an LLC. And unfortunately in the US, they also have for corporations, they not only have federal tax returns, they have state tax returns, municipal tax returns, county tax returns, and the paperwork can be absolutely insane. That's why there's not a lot of Canadian accountants that do US tax. It's a specialty.
Awesome. Oh, one more question popped up. Is it allowed to pay salary in the form of cryptocurrency, especially for employees outside of Canada?
Absolutely, you can pay current or salaries in cryptocurrency. CRA still taxes it as if it's regular dollars, assuming it's a Canadian employee. If it's not, so if you're a Canadian corporation that has employees outside Canada, you might be getting into some, well, you are getting into some international tax rules, and it would depend on what your employee, what the status is of that employee when they are outside Canada. If they are still an employee and paying Canadian tax, they're just a regular good old employee. But if they are an American citizen, for example, that has no Canadian residency, they're going to pay American taxes, and now you're going to be paying remuneration to a non-resident. So now you've got withholding taxes that you have to worry about as opposed to payroll taxes. And again, you can do that in cryptocurrency, but CRA is still going to get their piece of that pie.
All right. I think that's it for questions now, but if anyone else has questions, feel free to put them in the chat and I will keep this open and we'll pause and read them out and answer them. Okay, Amy, are you all done with this section here?
Yep, all
awesome.
done.
All right. So now we're going on to bookkeeping tips and tricks. So with every operation, every business, you're going to want to keep your records clean and straight. One of the main points is to keep all of your receipts. If CRA was to ever come back and question something or ask for some documentation, you have to have itemized detailed receipts. They will not accept bank statements or visa statements as proof if they are questioning something. So just file those receipts away, keep, folders and just tuck them away monthly, weekly, annually, and keep everything. So we do recommend using softwares to help you make this easier. There are softwares such as Dext, where you can actually take a picture of your receipt It reads the receipt for you, digitalizes it, and you can import that information into another bookkeeping software such as QuickBooks Online. QuickBooks Online will also help you keep track of, or even QuickBooks or Sage or other bookkeeping softwares will help you keep track of your income, your invoices, your expenses, so you can see reports on a regular basis, as well as just making sure all those transactions are recorded. We do also recommend using separate bank accounts and credit cards for business transactions. Just makes things a little bit cleaner, so you don't have to spend extra time organizing between personal transactions and business-related transactions. And one more tip that we have for you is to just keep on top of your reconciliations and data entry. If you do it on a monthly basis, it'll be a lot easier and a lot smoother to do the work, remember what happened, and you can go back and usually find things a little bit easier rather than, you know, prolonging it for a year or two or 10 years or whatever. So those are our bookkeeping tips and tricks. The next slide here is a list of some possible deductible expenses for your operations. Patricia is raising her hand. Did you want to ask a question, Patricia?
Yeah, sorry, my apologies. So I just want, what did you mean about something to do with your bank account? I don't know if you can pop back to the what does it mean to reconcile your bank statements? What do you mean by that?
So reconciling your bank statement is essentially going through your bank statement that you get from your bank and making sure that the transactions recorded in your software or Excel or however you're recording your transactions, that they match up. So essentially, if you spent $10,000 in the month, you want to make sure that you have $10,000 worth of transactions in whatever record keeping you have that is itemizing those expenses.
Oh, so it's kind of like cross-referencing, really.
Yeah. And so you'll find too, and one of the reasons that we recommend softwares is that the softwares themselves have that ability built into them. So you literally go through a list and you tick off what's on your bank statement. And then you just make sure that everything's recorded, everything's there, and it's all clean and smooth for your year-end filings.
Okay. Sounds time consuming.
It's not as bad as you think. Like I said, if you keep up on it monthly, it's usually easier to do it that way rather than doing a couple of years at a time. So.
Okay. Cool.
Unfortunately, it's a necessary evil, because if CRA voluntarily selects your name and randomly selects your name for audit, the first thing they're going to ask for is your bank statements. And then they want to see those bank statements all recorded in your records, in your bookkeeping records, however you may do that. And if they're not properly recorded, then CRA goes to town, and guess who's going to get hurt? So that's why we recommend to look after your bookkeeping, do it regularly, reconcile these bank accounts, because when CRA comes looking, they look at bank statements and then they want receipts matching those bank statements. If you don't have them, you're going to lose.
Okay. That's probably why I'm going to have a bookkeeper, because this kind of thing is just, I'm not an accountant, but I understand the basis behind it. It just wrecks my head. So it's like, it's just easier. But can you write that off? Can you write off an accountant's fees on your taxes?
Absolutely. Yep. If they are helping you with the operations and the bookkeeping and your, your year-end preparation and tax planning, absolutely, you can write that off as an expense.
Perfect. Thanks.
No problem. All right. So back to this deductible expenses screen. So this is a list of potential expenses that you may incur during your operations. It is not exclusive to this. There may be other items that aren't listed on here that are a little bit more specific to your business. Some of the key parts that we will want to touch base on here is the home office expenses. So if you're using a home office to run your operations, be it to do bookkeeping on a monthly basis, be it to meet with clients, you are able to write off a portion of your home office expenses. It would be based on the space that's used. So if you have a specific room that's used as a home office, you could write off a portion of your utilities and property taxes and mortgage interest, and use that as an expense against your business income. therefore lowering your taxes. The other big item on here is vehicle expenses. We will see in a later slide, one of CRA's biggest projects right now is tackling vehicle expenses. One of the main things that we see people struggling with, in a sense, because it is an administrative burden, is keeping a vehicle log. So if you keep up on top of your vehicle log, it will be less work for you later on to deal with all of that if CRA asks. A vehicle log should have the starting odometer, the ending odometer, the place where the address where you started driving, the address where you finished driving, the reason for your travel, and a date as well. All of this detail is needed by CRA to make sure that your vehicle is being used for business purposes. Failure to provide that log, they will likely deny this expense, which could be costly. There is a question from Tori. Can you touch on capital depreciation? Amy or Kevin, you guys want to tackle that?
Sure. So capital depreciation. So that's when you buy something big. So say you buy a computer that's going to be used over the next 2 to 3 years. You're going to be able to put that into a capital, into your capital cost allowance, and take a percentage of that every year. So say you get a computer and then that's going to go into this class and you're going to take 55% of it every year. And then that will be what's written off. So every single year, the amount of CCA that you can take is going to decrease. So you're going to take a lot of it in the first year, and then it's going to kind of slowly lower, and you're going to write off a percentage of it every year instead of taking the full expense in the year that it happened.
Awesome. Anything else to add, Kevin?
Nope.
All right. Reporting grant income. So this one will likely be a hot topic for startups, as you are probably all applying for grants. Grant income, unfortunately, is taxable depending on the organization structure that you have. It will be recorded on whatever tax return is being filed. I think someone is unmuted. I wonder if we can mute. I don't know how to mute everybody, so maybe Elena can do that, but sorry. So yes, the grant income is taxable. It will be recorded as taxable income on your personal tax return, partnership return, or corporate tax return, whichever is applicable. Most of the time, grant income is not HST applicable, but it may be. It would be written out in your agreement, whether it does have HST or not. This could be a factor for some people too, whether they have to register for HST if their grant income is applicable to HST and it's over $30,000 annually. So that's something to keep in mind as well, and make sure that's discussed with the grantors. Patricia has a question.
I'm sorry, you're going to hate me by the end of this. Okay,
it's all good. We love questions.
So it says the grants are revenue, but I mean, does that not depend on, even if it is revenue, does it not depend on what the grant is for? So say, for example, it's to buy equipment. Are you not allowed to write that off then, even though it's seen as income, money coming in, but yet it's going out in terms of like vehicles, and then you have depreciation and things like that on top of that? Can you not literally write it off even though it's coming in, because you're writing it off because you're purchasing land or you're purchasing a building or something like that?
Yeah. So definitely the grant income usually has very specific expenses attached to it. So of course that will reduce that income for your net income, your taxable income. The issue was when, if everyone remembers, in COVID times, when the government was giving out grants, and the CEBA loan that had a grant portion to it, the Ontario Small Business Grants, all of those are fully taxable, and they didn't necessarily have those kinds of expenses attached to them. Of course, there's expenses that are still associated with the operations, which can reduce that revenue for tax purposes. But The capital additions one is a little bit interesting, and this touches on what Amy had said previously. Of course, you're going to have to recognize that revenue in full when you receive it, but when you start spending it on capital additions, those don't get expensed in 1 year. So you're going to have expenses over multiple years for that equipment, vehicle, what be it, but you have to record that revenue initially when you receive it or when you recognize it. Does that make sense, Patricia? I don't know, is she still muted?
Yes, it does. Okay, thanks.
All right.
Yeah, I just thought, well, 90% of the people who apply for grants, they're putting it towards something. So it's money coming in, but there's already a label or a tag for whatever it is they're using the grant for.
Absolutely. So, yeah, most of the time it is attached to specific expenses. There are some times where it's not. So you may end up being in the positive because of the grant, which means then it would be taxable.
Goddamn government.
All right. I have a question here in the chat from Teddy. If an organization has a cap on certain expenses, but we still incur expenses beyond this, are we able to claim it on our personal taxes? Amy or Kevin, you want to tackle that one?
I'm going to suggest that Teddy's asking from an employee perspective. If you as an employee have a budget, okay, thank you, Teddy. If you have, as an employee have a budget and you hit that budget, but you still need to spend more money and you spend your own personal money on expenses on behalf of your organization, can you write those off on your personal return as an employee? It depends. Typical tax answer, it depends. Yes, you can, but they have to be certain expenses, and assuming the employee or the employer, sorry, will sign the correct form to say that as an employee, you're required to spend your own money on expenses on behalf of the business and you don't get reimbursed. So for example, if you're required to drive your own car for business purposes and your business only pays you $500 a month to drive your car, but with today's gas prices, you're probably spending more than that. So if you spend $800, you could write off that additional $300 against your employment income on your personal tax return. So yes, certain expenses can be, some expenses cannot be. For example, if you're required to purchase your own computer, I don't believe an employee is allowed to write off their own computer on their personal tax return. You can write off musical instruments, but I don't think you can write off a computer. It's just another quirk within the Income Tax Act that we love so dearly.
And that's all from an employee perspective, not so much as being a business owner or a startup business.
Correct.
Yeah. All right.
Another question from Patricia about VAT.
It was up here.
Well, that was VAT? Okay.
Yeah. How about that?
Oh, I'm sorry.
How about, yeah, Patricia answered it, but there was a question. How about VAT? Is it revocable in Canada? Patricia,
I answered that and I said VAT doesn't exist in Canada. It's called HST.
That's correct.
Because it's a European thing. So I'm in Ireland right now. That's how I know. And I go over and back. So henceforth the accent.
Awesome.
Thank you.
Thank you. All right. Tori, you have your hand up as well. Did you want to ask another question?
Yeah, sorry. I only figured out how to put my hand up after a while. Can you hear me okay?
Can definitely hear you loud and clear.
Excellent. Okay, so it's funny that he said musical instruments because that's what I bought last year when I got my Ontario Small Business Grant. So I'm not used to doing any sort of capital anything really in my taxes, and I do them myself. But I did use a chunk of that for buying instruments, and I was wondering when you take off that first chunk, it's like a class 8. I think it's, I can't remember if it's 10 or 15%. So is that, say it's $8,000 or something like that. And then, so for the first year, you can only declare a report or whatever it is, 15% of that amount. And then the second year is 15% of the reduced amount. Is that correct?
That's exactly correct. Yes.
Okay.
We're all nodding, but nobody's answering.
Yeah. Okay.
Yeah.
So then, yeah, so that, thank you for that. I thought that was what the case was. So, and so when reporting grant income, so obviously a big chunk of what I got, went to that capital expense, right? So I'm just kind of wondering how much that's going to bite me on the ass when reporting my grant income. So, I mean, because I'll keep obviously, reporting the depreciation every year, but I don't know, maybe I'm just speaking my fear out loud. Any reassurances there? Because I bought other things, and yeah, I paid for expensives, but
it really
yeah,
does
sorry, go ahead.
it really does depend on what your net income is going to be. I'm assuming you're not incorporated, so you're a sole proprietorship.
Right.
So it ultimately depends on what your net income is, because CRA doesn't care what you do with the money that your proprietorship earns. They tax you on your net income. They don't care that you went and spent it on musical instruments or a vehicle or a building or whatever. They're not going to allow that write-off fully. You take your capital depreciation on it, and musical instruments, if they're in class 8, that's 20%.
Okay.
But then what CRA did is they said, hey, let's give you a little bit of a bonus. So for the last few years, they've allowed us to increase the cost of the asset by 50%. If it's a qualifying asset, you get to increase it by 50%. And then you get to take full depreciation instead of just. Ultimately, it's a crazy complicated calculation. That's why we use software. But you end up getting almost 40 or 50% depreciation in the first year with these new rules.
Oh, I read about that, but I wasn't sure what to do about it. So is like I use the free. It's through Wealthsimple, that one. Yeah, and so it's pretty smart, right? Yeah,
exactly. If you put in, because all that software has to be certified by CRA, if you just put in the expenditure in the proper spot, that it's a qualifying asset, which I think has to be purchased after 2018 or something, it will automatically calculate the increased depreciation, CCA. It'll calculate that number for you.
What's that called again? What's that policy or whatever it is called again?
AIIP or something? Yeah. Accelerated
Investment. Innovative property or something like that. Yeah.
Like the AIIP or something, isn't it?
Yes. Yeah.
We have no idea what the hell it means. We just know we have to.
Yes, we do, Kevin. Yes, we do.
Okay, I read about that and I got excited about it. So thank you for bringing that up, because I thought, oh crap, can I do that? And so hopefully I can. That's great. Yes. Thank you very much.
No, it's all good. Okay, there were a few more questions.
There were some questions about research and development credits. So we will touch base on that shortly when we hit that slide. And then we can review this question and make sure that it was actually answered. And then we have another question here from Dimitri and Laura. So they recently registered their corporation in April. When do we need to file our first tax return if we haven't had any financial transactions yet? Amy, you want to tackle that one?
Sure. Typical answer, we're going to say it depends on what your fiscal year end is. So you probably haven't chosen one yet, but when you did the incorporation, you probably, depending on who did it, you might have signed a document that said, I want a fiscal year end of, I don't know, April or whatever. So typically if you just did it at April, it's going to really depend. You haven't had any financial transactions yet, so you can do basically a nil corporate tax return for the period until you have your corporate or until you have financial transactions. And then you can do a full year after that. It really depends, unfortunately.
From your date of incorporation, you have 53 weeks to select your first year end. So if you incorporated in April of 2022, you'll have until March 31st, depending on when in April, but March 31st could be your latest year-end period. Unless you were late April, then you might be able to stretch it with that 53rd week. You might be able to get up to April 30 as your year-end. And if you haven't got a lot of entries or transactions at this point, I would probably push your year-end period farther out and down the line so that you don't have to incur the cost of filing a tax return that has nothing on it at this point. Amy mentioned when you incorporate, you're supposed to select a year-end. That year-end can be selected in your legal documents, but it doesn't mean anything until you actually file that tax return. So you might have told your lawyer, okay, we want to use June 30th as our year-end, but if you have no transactions, that June 30 is not set in stone until you file that first tax return. So you could change it from June 30 to November 30 if you so desired. So it's very flexible in your first year.
And then for the due date, Dimitri and Laura, it is 6 months after your year-end date is the filing deadline.
Yep.
Tori, I think you had your hand up, but I don't know if you have a question anymore.
No, I'm good, thanks.
Awesome. All right, moving on.
On to SHRED?
SHRED.
Dreaded SHRED. SHRED stands for Scientific Research and Eligible Disbursements or something along those lines. It's research and development. And if your corporation undertakes qualifying activities, you can get a federal tax credit of approximately 35% of the qualifying expenditures. And it is a refundable tax credit. Or is it provincially that is refundable? And federally carries forward, doesn't it? The federal investment tax credit carries forward against future taxes. Province refunds your tax credits that they calculate. So if you have qualifying activities, most definitely fill out the schedule on your corporate tax return and on your personal returns as well. Fill out the schedules to ask for the scientific and SRED credits. You will likely be challenged on those credits because they are lucrative. CRA can then do 2 audits on your claim. They may do a technical audit and they may do a financial audit. Sometimes they do both of those audits. The technical audit is somebody from CRA that asks questions about what you're doing, how you're doing it, when you're doing it, who's doing it, to determine if it's a qualifying activity. A qualifying activity is, in general, something that is being done to undo something that is not doable, to figure out how to do something that hasn't been done. So for example, one example would be, you used to be able to get a research credit for redoing your manufacturing floor and where machines are placed so that workflow can be more efficient and more profitable. That used to qualify. CRA now says, no, that's no longer a qualifying activity. I used to work for a paint manufacturing company, and we used to have to develop new products for an application that a client would ask for. So they may want to paint for snow plows that the paint doesn't come off in the wintertime. So we would have to do a bunch of research to see if we could develop a product to apply to snow plows to make sure it wouldn't come off in the winter. The product didn't exist, the technology didn't exist, So the time and efforts we put into it, the materials we consumed to try and develop this project, those materials were qualifying expenditures. The labor we put into trying to discover this new product, that labor was qualifying wages, qualifying labor. We got to claim all of that against this research credit that's available. For startups, and I think that was one of the questions, that we're a startup and we're going to do some R&D. Startups struggle with R&D because, well, one, they can do it, but typically a startup doesn't have a whole lot of cash to pay themselves a wage. If you don't pay yourself a wage, you don't have qualifying wages. You don't have qualifying wages, you can't claim research and development credits because there's no expenditures to claim. So that's one thing that I do like to remind startups that are in R&D, pay yourself a wage somehow. Yes, you're going to pay personal tax on a wage that you draw from your corporation. The corporation may not be able to pay you that wage at that point in time because it doesn't have money. The corporation still gets a write-off for that wage because it becomes a payable to you. You're going to pay tax on that wage on a personal basis, but you can qualify for some research credits. So it has to be qualifying activities. The qualifying activities, then if they incur wages and or expenditures, those wages and expenditures would qualify for the research credit. So the technical audit determines whether you're doing qualifying activities. Then the financial audit determines whether your qualifying expenditures and wages are, call them legitimate, that you actually are paying wages, that you actually did pay suppliers for costs that you used in your qualifying activity. So it can get messy if they start doing all these audits, but recently they haven't done a whole lot of audits. So I'm not saying cheat, but if you've got some qualifying activities that you think are qualifying activities, absolutely make the claim. And then if they audit and they determine that they're not qualifying activities, oh well, you give the money back that they gave you when you applied for it. You wouldn't have got it if you didn't apply. So apply and take your chances with the audit. Will be my approach on the shred credits. So there's a question about on shred, it's only applicable to corporate contribution. No, corporation pays 15,000 to co-op, and a granting agent pays another 15. Shred only applies to the 15. Your question is correct. So yes, if a corporation pays this, your question is so everybody sees it. If the corporation pays 15 grand to something and then someone else pays 15 grand in, how much can you get? The corporation will only get the grant on the 15,000, assuming it's a qualifying activity. I thought why I said no is individuals with proprietorships and partnerships can also make shred claims. They get a little messier, but you most definitely can claim them on a personal tax return. No, that's apprentice credits I'm thinking about, isn't it? Mm-hmm. It has to be corporation. I lied to you. You do have to be incorporated. There's apprentice credits that I'm thinking of. Apprentice credits are on the proprietorships as well. Shred credits are not. They're corporate only. My apologies.
Kevin, there is one more question up above. If these incentives limited to R&D activities and expenses have to be done inside Canada?
Ooh. Typically, yes.
All right.
Limited to federal corporations activities. So are these incentives limited to federal corporations? No, provincially incorporated corporations can have these shred credits as well. And are these incentives limited to R&D activities and expenses done inside Canada? Yes. In general, yes.
Okay, we've got a bunch of questions piling in here. Let's focus on the ones that are shred for now, and then we can tackle the other ones after. So Charlene, you have your hand up too, but you did put a message in here. Does US have a 35% tax credit for scientific research development?
Do not know that answer. That would be a US tax specialist would have to answer that. And we are not specialists in the US tax.
Charlene, if you have your hand up still and you want to make a question or comment, feel free to jump in.
Okay, fabulous. Okay, so this is specifically for corporations, right? Just
Yes.
for clarification. All right,
Yes.
and then there's two kinds of audits. You said technical and financial.
Yes.
Okay, and then there's this term called qualifying activity. Okay, so the things that are done have to be a qualifying activity in order to count.
Yes.
Okay, and then the last question I have is, so if I'm looking for an accountant, like what specific kind of accountant should I look for? Because in terms of this, like, I mean, are they all going to be able to do this? Or I'm kind of under the impression that there's like some that kind of are more specialized in this area.
Absolutely correct. Not all accountants can do the shred claim. Obviously, most of us can do the financial part of the shred claim. Very, very few of us do the technical aspects. So when you put in your shred claim, you have to write up the technical report on what you're doing, how you do it, why you've done it, how you've overcome obstacles. We don't write that stuff up. We're bean counters. We don't know anything about technical. So if you can write those up, or there are shred consultants throughout Ontario that will write this up for you, and they'll even do the financial side of it and feed us the numbers of what they say are qualifying expenditures. We throw them on Schedule 31 on the corporate tax return, calculate your numbers, and then away we go. So if you most definitely have qualifying expenditures and you've got big money spent, it may be worth your efforts to have a shred consultant help you with the claim.
Okay, so shred consultant who then transfers those documents to an accountant.
They would feed us the documents so that when your tax return gets e-filed by us, all of that then goes to CRA together.
Thank you very much.
No, all good.
Kevin and Amy, do you want to tackle these various questions here, or do you want to finish the presentation and we can tackle these at the end?
No, let's do questions as we go.
Okay. So Margin asks, I want to know if the documents related to the 1-year performance of the company are checked online by the Ministry of Finance or physically?
Both. So the 1-year performance, so that would be your income statement that you're referring to. If CRA audits many different ways now, that used to be all just, they send you a letter and say, we're coming in on this date, here we come. Clear out some room for us, we're gonna rip you to shreds. I shouldn't use shred, we're gonna rip you to pieces. And then they want all documents, they want bank statements, they want every receipt, they want travel logs, they want everything. That's old fashioned. Nowadays, they send a letter and it says on line 14100 of your corporate tax return, schedule 125, you claim $5,400 for professional fees. Send us receipts. Send us receipts supporting this number. You send those receipts, they go away. You don't send those receipts, they're going to come guns a-blazing. So if you ever do get that letter, reply to it immediately, or have your advisor help you and make sure you submit that information. That's their typical way of doing it now. We call it a desk audit because they just ask for a few receipts and you send the information. They still do full-blown audits, but I would almost venture to say if they want to come in and do a full-blown audit and sit in your place of business for a few days, they're probably looking for a little more than a couple receipts. I'm not saying be scared, but be scared. So just make sure you've got your stuff in a row, reconcile your banks, keep all your receipts, all the stuff that Maggie was talking about previously, make sure that's what you do. And my slide, I used to do this seminar, I don't know, the predecessor to the cluster. And on the bookkeeping slide, all I had was do it. You absolutely must do your bookkeeping. If you don't, CRA are not friendly people to deal with.
All right, thank you, Kevin. Let's move forward to US taxes, and then we've got a question slide at the end. We'll tackle the rest of them there. So Kevin, you want to take it away?
What am I doing now? US taxes?
US taxes.
US taxes, couple points. Talk about Nexus and talk about US specialists. As a Canadian professional accountant, we deal with clients that have transactions into the US. As long as they don't have Nexus in the States, then we don't have to worry about US taxes. Nexus in general is, do you have a presence in the US? The theory behind it is the IRS is more bankrupt than CRA. So they want every tax dollar they can possibly get. So if non-US companies are carrying on business in the US wants a piece of that profit. So they've introduced this concept of Nexus. If you've got an office, so if you're a Canadian corporation and you put a sales office in Buffalo because you have a bunch of clients just across the border in New York and you want to deal with them and they want to deal with an office. So you decide to rent a little hole in the wall and you have a sales guy working out of there. You now have Nexus in the US. You now must file a US tax return, state returns, county returns, city returns. You've now opened up a whole can of worms. You better get yourself a US specialist. You don't get double taxed, but Canada and US are going to fight over you to determine who gets what tax. If you pay tax in the States, Canada gives you a foreign tax credit so that you're not paying twice on the same income. And same for US. They'll give you a foreign tax credit for taxes paid in Canada so that you're not getting taxed twice. But if you have that presence in the States, you're going to need a US specialist. Probably the large firms in Canada would have a US specialist, or find somebody in the States that knows Canada and US. Nexus is becoming more and more vague. It used to be real simple. If you open an office, you have presence, you must file. Now, I've seen cases where US has attacked where it's a Canadian company that has a sales guy that travels into the US and he might be there for a couple of days making some sales and then comes back to Canada and carries on that way. A lot of corporations do that. Technically, if that sales guy has the authority to sign a contract and that contract must be fulfilled, if it's signed in the US, technically you have presence in the US. You now have to file a US tax return. So we always tell our clients, the sales guy doesn't have authority. He has to bring the contracts, maybe they're signed, but he doesn't have authority. So they have to come back to Canada and then the president has to sign them and go, yep, that's a good contract. Now the mind and authority is in Canada. So you don't have a presence in the States. So you don't have to file the US crap. It'd be very weak. I think if we got attacked, we would lose and then you'd have to file those returns. But it's a gray area. But like I said, IRS is more bankrupt than CRA. So they all want your tax dollars. So if you are considering expansion into the States, you would be wise to talk to a US specialist first, so you know what your obligations are going to be.
Awesome. All right. Let's move on to the last slide here. CRA issues. Amy, take it away.
Yeah, sure. So right now we're kind of seeing CRA attack a couple of different things. The first thing is any basically capital asset addition. So like we said, like that's your buildings, computers, equipment, all of those capital items. We are seeing them attack those and ask for the records on those. Same with vehicle expenses and vehicle additions. So vehicle additions is huge right now in that capital asset category. So if you acquire a new vehicle for business purposes, make sure you have good records of that. And then same with your vehicle expenses. So as Maggie kind of mentioned before, keep very good records of your vehicle and the business use portion. Keep your mileage log, have that handy in case CRA comes and asks for it, along with all of your receipts. And same with professional fees. So professional fees is another big one that they're often asking for all the receipts for that one as well. So very much it just boils down to keep good records, keep your receipts, make sure you're doing your bookkeeping. And then when CRA comes to question it, make sure you touch base with your accountant or try and respond to it yourself. But typically I would just send that over to your accountant to respond to, as we kind of respond to them all the time. Last thing we wanted to kind of touch base on is the HST issue of non-compliance. So often if you have a filing deadline for your HST return and it hasn't been filed for say 3-6 months after the filing period ended and when it's due, then they're often going to send you an arbitrary assessment. So that's just basically a made up number that says, hey, now you owe us $6,000 because you didn't file it. All you have to do is go in and actually file your HST return. That gets reversed. But that's kind of their way of forcing your hand to make sure that the HST returns are getting filed.
Awesome.
HST, I'll just jump in. It stands for Harmonized Sales Tax. So it's the 13% that's being charged in Ontario.
Awesome. All right. So that is the end of the presentations. We've got a couple minutes here for questions. We'll go back to the chat quick because there's some people that have been waiting. So there's a question, how do you pay yourself wages, or do you call it owner's draw? Amy?
Yeah, so that's correct. So you would still pay yourself a wage, even though you're actually not taking it out of your bank account. And then that would sit in your owner's draw account to be taken out at a later date. I'm assuming that relates to the shred stuff so that it is a corporation. So you do have your owner's draw account.
Patricia asks in the chat, what's the difference between a not-for-profit and an NGO in terms of tax in Canada? Do you have to be incorporated if you are a not-for-profit?
Maggie, you're the not-for-profit specialist.
Oh, goodness. I actually don't know this one off the top of my head because I thought that you had to be incorporated to be a not-for-profit. But I have been recently told that you may not need to be. So it depends, our favorite answer. Not-for-profits cannot earn taxes, it can't have profits, as the name suggests. So there's no taxes on it. If there is a little bit of profit or if there are losses, there are no tax implications, but the government generally does not like to see profits building up in that because there are no taxes being paid. The difference between a non-for-profit and a non-government organization, is that what NGO stands for, Kevin?
Yeah. Yeah.
Do you know the answer to that one?
The same.
Okay. All right. Patricia, does that answer your question? You've got your hand up too. I don't know if you want to jump in.
Yeah, excuse me. Yes, it does. Thank you. The reason I'm asking is because I have an ingenious idea of setting up an NFP. But I also know that you can make a profit so long as the profit that you make goes back into the business to improve the business. Is that correct?
Yeah, yeah.
In not-for-profits?
Pardon?
As a not-for-profit?
Yeah, like you can make a profit, but the profits have to go back into the business.
Yes, it's called a surplus.
Yeah. Okay. Perfect. Thanks.
Yes,
yeah,
you can make a surplus. Sorry, go ahead, Meg.
I was just going to say, as long as there's a plan to use that money in the future for future operations, then absolutely that's acceptable. It's just when you've got this surplus building for an extended period of time with no plan, that's when the government will get a little grumpy because you're not paying tax on that surplus. So just make sure that there's a plan for it.
They're grumpy no matter what. It doesn't matter.
That is correct.
Quick. This is about the US. So is it possible that you can have a business in the US but be residing in Canada? Like you can register a company, and do you have to pay tax in both places?
Yes.
Yes. you can register it, or yes?
Yes to both.
Yes.
You can register a Canadian company and it does business solely in the States. You're going to pay tax in both places.
Okay. Okay. And
now,
one last.
Presumably, there's going to be an offsetting foreign tax credit against your Canadian taxes. But because I don't trust the IRS or CRA, I'm not going to suggest that it's going to work properly. So typically, if we have cross-border transactions, a US specialist and a Canadian specialist are going to say, set up a US company, set up a Canadian company. Each will file its own taxes. Don't have a whole lot of intercompany corporate transactions. Because if you start deciding to play games, what do they call it? Tax shopping, I guess they call it, tax rate shopping. And if you decide to set up a corporation in New Jersey because there's no state taxes, and so the taxes overall are less, CRA and the IRS are both going to beat you up. And you're going to be tied up in courts for so long, it ain't going to save you no tax.
Okay. And one quick question is, can you register a business in Canada as a sole proprietor without actually being a resident in Canada? Like without physically being there, like physically being in Canada? Is that legal or no?
You have to be a Canadian resident in order to have a sole proprietorship.
Okay. Okay. All right. Okay. Perfect. Thanks.
All right. Now it's after 1 o'clock. We still have some questions. I don't know if
keep going.
We want to keep going. Okay. We'll be quick. What about online transactions done online where purchases are done in different states or countries, but company is based in Canada?
Good luck. CRA has just issued a bunch of interpretation bulletins and whatnot on that. And basically it boils down to they will find you and they will tax you. Because again, companies are taking advantage of the lower tax rates wherever they may be it in Canada, be it in the Caribbean islands, wherever. And they figure if you do stuff online, then you don't have to pay the taxes. Somebody will tax you. There's now a whole bunch of international tax treaties, and they're becoming more and more prevalent every day. They will find you. Somebody will tax you. If you're a Canadian company and you do online transactions, CRA will, right now, I believe they default to where your servers are. So if you're in Ontario and you're doing transactions, a whole bunch of transactions in the States, they'll probably tax you as an Ontario company. And it's whether the IRS will come and get you because you're doing transactions in the States. Depends on how you're doing them. But more than likely, they will deem that those transactions are incurred in Ontario. You pay the taxes, corporate taxes in Ontario. For HST, if it's a US customer, you charge them no HST. If it's an Alberta customer, you charge them Alberta HST, which might be a different rate than what it is in Ontario. I believe it is a different rate. So every province has a different rate. Some have harmonized sales tax, some have GST plus provincial tax. Quebec is a whole new ball game. It has QST, if I'm not mistaken. And you got to file returns in those various provinces. It's a pain in the arse. If your company's going to be doing transactions with different provinces, make sure you talk to your advisors first so that your software is set up properly and you're properly charging the right rate to the different customers.
That made my head spin. So I would probably have to get an attorney and an accountant that knows these things.
That's a wise move.
Wow.
Proper advisors to make sure you don't get yourself in trouble.
When you say advisors, what do you mean by advisors exactly?
Anybody that doesn't do anything except spout off at the mouth and tell you how to do it.
Okay, thank you. Very helpful.
Advisors as well. We can help you on how to set up your company to maximize tax benefits and minimize tax, but we shouldn't give you advice on how to incorporate a company or how to do corporate minutes, because that would be a lawyer that should give that advice. So it depends on what you need, on what advisor you should find.
Okay, fantastic. Thanks so much.
All right, so we have another question here. We plan to import raw materials to Canada from the US. What taxes will it be subject to and in what amount in percentage? And do we need to do import/export registration?
When it comes into the border, comes across the border, you'll get charged with HST. And should you do an import-export registration? Yes. We happen to have a client that is an ex-CRA excise tax specialist. And if you want some help in that area, we can give you his name and number. He'll talk your ear off, but he will definitely help you walk through the import-export process because it can be a disaster. There was a question before that.
It's already addressed. We've got time for one more question. Kyle, you've had your hand raised for a while.
Hi, everyone. Yeah, thank you. This is amazing what you're doing here. Very informative. I wanted to run a quick scenario by you. I have incorporated a long time ago, and I am building something that very likely qualify for SHRED. However, I just put my own money into my bank account, or the business bank account, and then I just build away and build away for, it's been a couple of years now. Should I be charging a salary to myself this whole time and not paying it? And then if I can get SHRED, using that to somehow make better financial decisions?
Yes and no.
Okay.
It would depend on your personal tax situations on whether we want to charge a salary to you and build up this credit within your company and then qualify for SHRED. But at a minimum, the expenditures that you're incurring, those are likely qualifying expenditures. So you can likely get SHRED on the money you've spent on supplies and whatnot. Doing a payroll at this point, probably not, but it is a possibility. You could say you paid yourself a minimum of $3,500 a year. You don't have to pay any CPP. You don't pay EI. You're probably not paying tax on it. You do a late filed T4, pay $100 penalty for a late filed T4, but now you got $3,500 of additional monies qualifying for SHRED, 35% credit. You probably get $1,000 refundable credit on a federal and provincial basis. So we'd have to look at your specific circumstances, but it might make sense to do something like that.
Okay. That sounds like too much work for too little money.
Yeah. It can be a lot of work, yeah.
But thank you for responding.
No problem.
All right. I think that's it. That's all. Alana, you want to take it away?
Yeah, thanks so much. Thank you to everybody. And thank you to the Inclusive team. I know that was a ton of information, and this is going to be posted on our YouTube channel, so you can refer back to it. We will likely hold another session much like this one in the future, so stay tuned to our social medias when we promote it. And if you do want to contact the Inclusive team, you can send me an email and I can connect you. So thank you so much to the team today, and thank you so much to everybody that came and attended. So thanks, and see you guys later.
Thank you, everybody. Bye, everybody.
Can we answer those questions?